Hello, everyone. This is Shane with Trade ATS. Before we go ahead and jump into this, I just want to double check with everyone that you can hear me all right and that you can also see the screen up. All right, perfect. Thank you, Baldev. You were first to the punch. Anyway, sorry about that. We ran into a little bit of technical difficulties getting this PowerPoint to show up, but anyways, looks like it's all working now. So with that being said, I just want to welcome everyone to the webinar. For those of you that have never been on before, we're going to be going through some markets. In today's case, we're going to be looking at this PowerPoint that Wade put together. As you can see, how to accurately define the Forex master pattern. So we're going to be going a little bit deeper into that because I know we get a lot of questions about it. As far as kind of what you can do on your side for interaction, if you're looking at a market or have more specific questions, today we're going to probably be taking those a little bit later on in the session. But feel free to type in the pair that you're looking at and the time frames that you are looking at them on. So if you're looking at them on a 15-minute with a 4-hour as your direction, make sure to say that just so we can look at exactly what you saw or how you're trying to do your analysis on it. This webinar is not for technical support questions. So if you've got something with a license key or something along those lines, we try to keep these to only market talk. Those questions, make sure to send them over to support@tradeats.com. And then we'll get them taken care of for you over there. And one more thing, if we are not able to get to your question, because there's a lot of comments that come through, feel free to save it and we can have a more in-depth discussion off the webinar. Just send that same question over to support@tradeats.com. Anyways, with all of that being said, I'm going to go ahead and hand it over to Wade, and he's going to take us through this PowerPoint.
All right, thank you, Shane. I want to apologize to you guys for starting late. I got one of those new 49-inch ultra wide curved monitors, which is really cool. But I've never ran a PowerPoint on it, and it's apparently doesn't want to. Well, as you guys probably saw, it's just I couldn't get the thing to show the actual right view. So anyway, lesson learned, and we'll figure it out. So I'm showing you the presenter view right here. I don't know if it's going to be a little bit clunky, but anyway, I put this together. This is something. It's actually kind of an outline for a new YouTube video that I'm going to put out. But I wanted to share it with you guys first and put it out there. I don't know if it's totally done. I might add a few more things to it, but I figured give us something to talk about, and then we'll kind of go from there. You guys can give me some feedback on it. So anyway, so the theme of the PowerPoint is how to accurately define the Forex master pattern. One of the biggest questions we get is like when people see the master pattern video, which is by far our most viewed video on YouTube. I'm sure everyone here has seen it at some point. They ask, how the whole, global view of the master pattern, how do you define it? How do you, and this is for people that aren't necessarily subscribers to ATS. They want to know, like, how do I see this? How do I, define contraction boxes? How do I, to the best of my ability, map this out on a chart? So that's really what this video is designed to do, is to kind of create value that way. But even though it's geared towards people that may not be subscribers, I think that you guys, even, you guys have the chart mapping software that automatically puts these components on your screen. I still think there's something for you guys to learn with this. So, that I think it's definitely worth going over. And I've never given this presentation before, so I'm just going to kind of go through the slides and talk about them. And if you guys have any questions along the way, feel free to type them in. And I'm just going to kind of jam through it, and then we'll look at your guys' questions as soon as I'm done. It's not very many slides, so shouldn't take too long. And we expect the webinar will probably go here about an hour or so. We'll get into it. And then after that, like Shane said, if you guys have any markets or anything that you guys are looking at that you want us to give some commentary on, we could do that. We just need to know the market, and we need to know at least 2 time frames, your entry time frame and your supporting time frame that you're looking at. That way we have the information. If we don't have that information, we may not be able to get to it. So anyway, that being said, let me, to the best of my ability, try to get into this, and hopefully it works. So bear with me if it's a little bit clunky here. Um, okay, so again, this is about defining the Forex master pattern. This is the global overview of the cycle. So, and again, like I said, this video is more for people that may have not seen the master pattern video. So we want to kind of cue that up so they kind of have a little bit of understanding of what, what they're getting into here. So this just to quickly bring you up to speed. What is a Forex master pattern? You guys already know this. It's a constantly repeated price pattern that happens on all time frames and in all markets. It's not just Forex, it's stocks, it's commodities, it's everything, because it's based on price patterns and how beliefs play out in the market, and the mediators in the buying and selling with the market makers. So it's based on that, and that happens in all financial markets. So this could be recognized. It's one of the most consistent forms of alternative technical analysis you can learn. I call it alternative because, as you guys know, it's not widely taught what we talk about here. It's definitely on the outlying spectrum of technical analysis. Most people are drawing support and resistance and trend lines, and putting Fibonacci's and using moving averages and things like that. Nobody talks about expansion legs, or sometimes people call them manipulation legs, and contraction or accumulation. No, there's not a whole heck of a lot of people that talk about this, although it is getting a lot more popular. I'll say for the last, we've been researching this kind of methodology for over 10 years. And back when we started, it was like a very, very little known segment. There are a couple people out there talking about it. People like Martin Cole was one of them. One of the first people that put a framework to it. And then there's some other good people out there that talk about it as well. But originally this thing originated, if you wanted to go back to the real originators, would be, Richard Wyckoff and, Jesse Livermore, and those older trading tactics are the first people that kind of started, putting framework to this. But since then, because it is a complex subject, what I've noticed out of everybody that talks about market makers and things, everybody comes up with their own little way of seeing it. And it's not wrong or different or anything. It's just everyone has, the nuances of this. They define it in certain ways. For instance, like Martin Cole, he's a great guy. Puts out a lot of good stuff. But he calls accumulation and he calls it manipulation after accumulation, which would imply that the markets are always being manipulated, in kind of like a manner that they're out to get everybody. And I think that definitely does happen for sure. There is some willful manipulation, but just the way the market makers need to do business, if you study on it, it calls for them to balance their portfolio. It's just the way they have to do it, which causes, what seems like manipulative behavior. But that's just the nature of how the business is done in the markets as well. So, little things like that, we decided we're going to call that expansion because the markets are expanding. We feel like it's a better way to talk about that type of activity rather than always implying that it's sinister. I don't think that that's necessarily the case all the time, although it can be. But it's not. It's just a cycle of the market and nothing more. So anyway, I don't want to get too deep into that, but it's an alternative technical analysis. A lot of people talk about it. But this is definitely our spin on how we define it, and it makes sense to us to define it this way. So, and again, it's completely based on how the smart money institutions interact in the financial markets. We're talking about buying and selling, the balance of the markets, and the mediation between the market makers. That's everything that we look at is basically clues and components of how that business is done, and we use that to define the market, the sweet points in the market to manage the trades and come up with ideas and create that consistent framework. Okay, and you guys have seen this. Again, it's just a Forex master pattern, just in general. I know it gets more complex than this, but this is just to define the components. You got contraction, expansion when you leave the contraction box, and then eventually we're going to get a trend that goes to higher or lower prices and then starts a contraction cycle again. So this is the generalized pattern. So people see this right here and they want to know more how to spot this global view. They want more than just the basic strategy of, okay, we're looking at a higher time frame and we're looking to buy the pullback in with timing of contraction and counter trend liquidity. I know that's a basic strategy, but people, I think they get stuck on this and they want to know more about this. And you can define this, and that's what I want to talk about, is how you guys can do that, whether you're using ATS software or not. You guys can do this on a chart, and you can define these phases, and and you can use it to figure out enough framework of the market to figure out where there could be some good risk to reward opportunities. Okay, so this is slide, can you spot the Forex master pattern? And remember, this is again going to people that maybe have not seen that yet on YouTube. So in here, you can see this is just, looks like just some random bar data, but you can see in here, you have your contraction phase, which is a market maker balance point. Then you have your expansion phase, then it settles above, and then you got your trending phase. So, just to emphasize, the pattern is out there. It does happen. You just have to be able to spot the components of it to accurately map it out, which is what we're going to get into here in a second. So what you're going to learn in this training is I'm going to teach you how to correctly identify the Forex master pattern and map it on your charts. This will allow you to break down the seeming randomness of the market and classify each movement as within a defined phase. The correct mapping of this pattern will help you understand the market from the institutional perspective. And this is something, again, that we've studied to trade ATS. It's been over 10 years that we've literally focused down on this methodology. So, that's why we know a lot about it, and that's why we don't really talk about anything else, because this is, from our opinion and what we have observed on the markets for a long time. It's the markets are nothing but price action. And understanding the phases within that price action. When things are tightening up, they're contracting. When things are expanding, and the framework that causes. And after over 10 years, I can tell you is that there's nothing as difficult as it still is. This is the tightest technical analysis that you can get, is mapping out these levels and understanding it. You're not going to ever get anything that shows you more exact price levels and potential turning points and management points to build a consistent framework on the chart. And believe me, I've done everything. You don't want to know how many rabbit holes I've gone down. Thousands of hours, thousands and thousands of hours have gone into studying this kind of stuff. On weekends, I used to look at charts when the data wasn't even running. I would spend hours on Saturdays just going back, mapping things out, learning about this. And like I said, after all that time, I haven't landed on anything as a base framework that is more consistent, that shows more consistent information to work with than this. So, okay, so that being said, it all starts from the contraction zone, the all important contraction box. And so this is a defined balance point on a chart where the market maker conducted an equalizing two-way business between buyers and sellers. That's what creates this contraction. Some people will call it consolidation. Some people will call it accumulation. We think contraction is the best way to put it, because the markets are tightening. So in this area, market makers can evaluate supply and demand, which allows them to create a portfolio management plan. It allows them to, figure out how they're going to dump their bad positions that they accumulated in there. Because if they don't, they're going to lose money. They're going to be out of business and they can't do any market making anymore. So this is a necessity of what they have to do. Most of the time, the smaller trades are all done by automated algorithms now, but especially the bigger positions that are still called in over the phone and things like that, the market makers need to figure out how to dump. If they feel like the markets are going to go up, they have to dump their bad sell positions, after they evaluate supply and demand. And the way to do that, is they have to push the market down, or if the market naturally falls, they have to get rid of those positions, which causes the whipsawing action. So, you have to, this is that expansion phase coming out of the contraction is nothing more than them figuring out how to not lose money first. And then if they can actually make some money, accumulate some better positions, then better. That's how you be a good market maker. You make money for your firm and get big bonuses by effectively managing the book of business and trying to unwind toxic positions that you feel like aren't going to be good. So, and that's what creates a lot of this price action. So what's the most important is accurately defining this area and then analyzing what comes in the next market phase. So if you can accurately define this contraction zone, you got 80% of the framework that you need to figure out how to build a trading plan around the sensitive price points in the market. Which is what ATS software is all about. It's what this whole thing's about, is accurately defining this zone and then mapping out those levels. So how do we accurately define the contraction zone? So the main characteristic of the contraction zone is simultaneous lower highs and higher lows. Some people will call this a price wedge. I don't know. They got all kinds of technical pattern names for this kind of stuff. The fact is, price is tightening. Now we have a proprietary algorithm that defines this in a way that we feel is the most accurate, but you can define it generally just by looking at the chart. If you see the price tightening, as long as you find a high and a low to go off of that's tightening, you can pretty much accurately define this well enough and then draw a center line out of that. So the simultaneous lower highs and higher lows is your initial indicator that you're in the contraction phase. When you see that settling inside, those lower highs and higher lows. But there's also a second part to this, to defining the global overall view, which is cast back by the expansion phase as well. So the expansion phase can also define the contraction point as well, right? So if you know the simultaneous lower highs and higher lows are gonna, signal a possible contraction period, then you know that the expansion period can now point back to that. So you have a two confirmation, once this is fulfilled, that solidifies the sensitive price point coming out of that contraction period. So you might be asking, isn't it too late to identify a contraction box by its expansion phase? You're like, okay, well, what's the point? I see the legs now, why would I care, about a box that already happened? And I'm going to tell you why. There are countless situations where the market forms 3 or more expansion legs. Okay, and this is the global view of this overall activity we're about to talk about. This not only gives you time to discover trading opportunities, it solidifies solid points of market architecture that become key levels later. Okay, so here's an example. Price data right here, pulled out of, I think I pulled this out of Eurodollar, I don't remember. But these were all, I didn't build these candles, and place them. This is just, data I found that is showing this. So right here, you see we have a swing high, right? Okay, that's an expand high. After that, we have an expand low to lower. Then we get an expand higher, swing higher. Now we swing lower. Now we swing higher. Do you guys see the back and forth whipsaw expansion happening? And it doesn't matter what time frame this is on. It happens on all time frames. So whatever time frame you're trading, it'll be relative to, just simply finding this. But you guys see that's an expansion. How many? We had 1, 2, 3, 4, 5 swing highs just in this, and they got progressively bigger, if you guys can see. And every time it passed the previous lower high of the last low swing or last high swing, you typically either get a reversal and it starts heading back towards the lower high, or eventually it'll go into the trending phase, right, and keep going. But you see the framework and the structure coming out from this master pattern global view. So all of these swing highs and swing lows point back to one central point. You guys see that? They're defined by the high and low, and you see that whipsaw action. You can define it back to a point of origin. You guys see, so this is just the same movement. I just squished it up a little bit. That's the point of origin. And you could have defined this point of origin after the first swing high and swing low. You guys understand that? So that's that first pop out of the box going long, and then you swung low. If you're seeing this on your software and you see that you have a box that has a lot of swing high, swing low activity around it, that is going to put a little more emphasis on that box. for it becoming more of a global box. So, and I'll, you guys, just to give you some insight, part of the updates and things that I'm working on, I don't know if it'll be on the next update, is to put more importance on certain boxes that have the potential to become a more global view box, that have this type of activity and become more of a higher sensitivity average price line or expansion line. We're going to start separating them, and like I said, that's a project here probably in the next, few months after we finally get the new licensing system out. But there's a lot of ways to get more intricate into this, but I want you guys to see that. This is how you could have defined the importance of that box, started to define it by the first swing high, swing low. And you see how price swung and danced around that center line. Well, now that you know that that's an important line, how can you use that as a risk point when forming your ideas? We talk about this on the webinar, how the boxes all work together, right? I tell you all the time, you can't look at one individual box. You need to look at the global overview and how they're all working together. Inside this master global view, how many other cycles are within that? You guys see it? So if we can define one point of that's a significant level, then we can, there kind of becomes a dance and a tango between all these other points within that. Hopefully you guys make sense if you're seeing the framework here. If you're below that original point of origin, maybe you want to have a long bias. If you're below, maybe you want to have a short bias on the minor cycles. Either way, you're getting framework. You're getting framework, and it gives you points of management all throughout that. But going back to what I want you guys to get from this presentation is that by just looking, it doesn't take a rocket scientist. If you guys just kind of, instead of, you know, like Shane says, gargoyling over your computer, or looking and focusing on every minute pip and detail, relax your eyes for a few seconds, zoom out of the screen a little bit, and see what's showing you a swing high, swing low. That first one, and see, is there a point of origin back there? And better yet, you have action threshold software that shows you all the sensitive points in total, but can you spot ones on the chart that have more swing highs and swing lows pointing back to that box? That becomes a bigger, more significant point of view in the global overview. Now, what I'm telling you right now, you'll say, well, I didn't really learn a lot about this when I got into the course, and this can give a lot of insight. Is probably what a lot of you guys are thinking. But the basic strategy is something to get you guys to look at. Hey, if the market's going long on your higher time frame, you want to buy below, your shorter time frame expansion lines. If it's going short, you want to sell above. But what you guys eventually, those of you guys that stick with this methodology, whether you use ATS or not, I always tell you, I'm the worst salesman for ATS ever. If you you guys don't need it. I think it makes it a lot easier, but this stuff it's happening all the time. So the strategy that we talk about is a strategy showing you someone who has never had any introduction to this kind of thinking, how to get and to potentially get a strong position inside an existing trend. It's a trade that's already happening on the higher time frame. You're trying to find a safe point to enter. If you combine that with more experience over time, spending time with this methodology, like I said, whether you use the software or not, you start to see the overall framework, what's going on. You start to see the extra sensitive points defined by the expansion. The more expansion, swing highs and swing lows it has again around that point, the more that point starts to hold water as a tipping point of buying and selling pressure. So hopefully you guys kind of see that here. So, and I know this is probably pretty deep. Feel free to watch this over and over again, but This is a reality. This is a reality of what's going on, in the price action behind those charts. And as you can see, if you're looking to enter, if you still using the regular strategy, if your longer time frame, you're entering on your short time frame. On your shorter time frame, you can see this. If you look back a few boxes, look to the last box that had a lot of swing high, swing low expansion activity around it, and see where you are in the global overview of that. And I'm sure we're going to look at some charts here, and we'll use this as a theme going forward and talk about that more once we get into the live charts. Um, anyway, that's what I got. And this, like I said, this is just a template. I'm going to put this out on YouTube, hopefully in the next few days, if I can finish it. I don't know. I may add some more stuff to it, but hopefully you guys benefited from it. And anyway, that's pretty much it. Let me see if there's any initial questions about this while I got this up, and then we'll get into some more general questions. Hang on one sec. Okay, good question from Rick. He says, I talk about balancing order books and balance point. What's that all about? Is there some additional reading you point me to that I can do in my spare time? Yeah, a good resource is Richard Wyckoff. And I actually, believe it or not,
Hey guys, a little weird, but yeah, just talked to Wade and had a little bit of a hiccup on his internet. Give him 1 second and be getting back on here in just a sec. Yeah, I know, and it left off on a little cliffhanger too. He said the most important thing, and then it cuts off. Anyways, sorry about that. Give us just 1 second.
guys, can you hear me all right?
Yep, there you are.
Okay, I think we lost connection on my internet here. I don't know what the deal is, but yeah, everything cut out. So hopefully we're back on. Everyone can see. So I don't know where it cut off quite, but anyway, I'll go back. I was recommending a few books. Anyway, one of them is How the Trading Floor Really Works. We'll take you guys into deeper about how there's some good sections about how market makers work and how that business is done. And then there's also a book that I got. It's a real snoozer. But if you really want to get into deep things about how the markets work, it's a book. I got it off Amazon. It was originally published in 1996, it says here. but it's called the practice of multinational banking, multi-policy issue or macro policy issues and key international concepts. Um, anyway, like I said, it's a real snoozer, but if you're into going deep into this stuff, there's some good stuff in there. So, okay, Wyckoff. Okay, yeah. So anyway, I was talking about, yeah, the Wyckoff Richard Wyckoff is another good resource. You know, there's some old material, obviously outdated, but there's definitely some basic things you can learn in there as well. And really, it comes down to, you know, there's not one perfect source for all this stuff. It just comes down to understanding enough about it to kind of come to your own conclusions. You know, we're not trying to find out every single perfect thing about the market, you know, and come up with the ultimate strategy where you just, you know, can, you know every single move that's coming. Where you just got to come up with enough of it to have some good management points for entries and risk, and that's it. So, you know, there's not I'll tell you right now, there you can spend a lot of time digging into all that stuff, but at the end of the day, it comes down to, you know, if you're going to trade this way, it's about boxes, it's about expansions, and it's about average price lines. That's about it. And it's about mapping the global overview. And then if you need some help understanding it, you pair a higher time frame to figure out the overall trend, and you find good management points. You wait for those points to come to you, and you rip the trade. That's pretty much what it comes down to. So, okay, so that being said, I'm gonna wrap this up and with the PowerPoint. Shane, if you want to go ahead and answer, if you wrote down some questions here, I'm going to catch up on some of the other questions that came up, and we'll keep going here.
Sure. Yeah, give me 1 second. Let me get my notes together here real quick. There was one question that got in an email that was actually asked to be brought up here on the webinar. And Wade, I'm sure you can speak to this as well. The question was how long, and I also think it's fitting given the presentation that you just went through, but the question was basically, how long are expansion lines relevant? So expansion lines are relevant, as you saw with Wade, a box, a contraction zone can kind of set off an entire range on a little bit larger scale. But as far as when you're using expansion lines and you're just trying to get into a small little entry and use them in that way, remember that we call expansion lines, it's kind of interchangeable with average price. So they represent the average price that trades were placed inside of a contraction. So if price whips up and down through that expansion line, then we can kind of see that, the orders that were placed there might not be as relevant anymore. So here's a good example up on the chart, on the monthly chart on the left. We see that we had the last box that we had, price whipped up and then whipped down short past it. So we might not be putting as much emphasis on that expansion line for, looking for reactions. Whereas the one that the tip of the wick got real close to, that one, it just kind of broke out long from that. So we would still be looking a little bit more for that to have some reactions. And Wade, if you have anything that you want to add about just how long expansion lines stay relevant.
Sure. So the expansion lines, all of them are relevant, and one that had a breakout, and doesn't seem that relevant can be relevant later on. The expansion lines that are relevant are the ones that price is closest to at the moment. So if price is coming down to a level and it's interacting with that level starts to become relevant because it's in real time. That's just where price is at. Like Shane said, you got the Dow 30 monthly chart here, and there's all kinds of crazy fundamentals going into this chart right now at the moment. But if you want to go from a purely technical standpoint, what I see right here is, we had on this expansion level, especially this one right here, where we have expand high, expand low. We have an expansion line right here, expand high, expand low. So coming back, this may be turning from right here on the daily. So if you're trading the daily into the monthly, This could be turning right now. I'm not saying like this could be a possibly great entry point, but managed obviously tight with using correct risk management, within this turn right here. I would say that the immediate upside is you're coming at least to this expansion level, and it's no different. The basic strategy is not different depending on the time frames. It just takes longer the higher you go. But looking at this global view, if you're just looking at, okay, we're under expansion right here, right? Yes, that is the basics. That's the basic strategy. As you get more advanced, you start to look at this overall as that global view. Well, I see that this expansion level right here, we had an expand low, expand high. Now we've expand low. That's how many? One, two, we're on the third leg around this level. So I would not be surprised if this doesn't work out short here, that we didn't come back up and get very sensitive between these two expansion points. You guys see that? That's a global view. So that gives you the overall framework. Let's go back and look for more. Right here, we had a box, expand high, expand low, two expansion legs, signaling, pointing back to this as a significant point of origin, right? Right here, box breaks out, nothing. We just had a straight breakout. Box breaks short. Well, if you're trading, if this is a monthly chart, I know none of you guys are looking to enter on the monthly, probably for the most part, but still, even so, we break. This was more of a sensitive price point. Look at, we come down and you get a big reaction off that point. There's the price settling above that and going into the trending phase. Also here, look at this. This one expanded low, expanded high. That's at least two expansion legs pointing back to this is more of a significant box, comes back, holds that expansion level. And it very well could have had another one go short as well. But again, that's the management point. That's a sensitive tipping point. Same thing right here. Expand high, expand low. Where do these expand high and expand lows point back to? Right here, right? So this is not only holding the significant point from right here, this is holding the significant point from back here as well. All sensitive price levels. And we haven't had a significant one on the monthly since right now. So when all this settles out, we'll see what's really going on with this whole virus thing and how this settles out. And if we get a pullback, we may get another momentum push down. And you have risk management. If you're shorting the Dow, you can do that within here. But just understand, we can't predict the future. We just got to come up with risk to reward opportunities that make sense. Preferably in trend. And this is a first opportunity. However, if this doesn't work out, let's talk about the downside. It comes back up. You get back up into this level right here, and then you see a big reaction on the daily. What price is that? It's like 25,350, we'll call it, right? So where's 25,350? Okay, basically right about here. So if you get another leg up and then you get a heavy reaction, then you're still coming back to, because you're still managing the trade off of this point, right? So that would be showing that you're settling below that global expansion that's happening. Again, just scenarios. We don't know what's going to happen until it does, but it provides us with those sensitive points where you can take the trade. And if it goes against you, if you short it from up here, you start getting a reaction. You got a big fat upside down to here. And if you get through there down to here, and then if it really breaks, well, I mean, let's put it this way. I don't know, those of you in the United States, I don't know if you really want to win this trade, because if it gets much down to here, your life's going to be different. So you may need to leave the United States. But anyway, that's just talking about the price action and the technicality of it. Hopefully you guys see what I'm talking about there. Shane, you got any more questions we want to touch on?
I think that's it for now. Well, as far as some that were kind of prescriptive, it was just really the one that I thought was important. So that was stuff that was sent in, but there's one here. So Wade, I think maybe you might want to touch on this or just give a little bit of just some feedback on it. So sometimes I'll get emails and people think that they're bugs with the assistant where it'll say a cell, but it's above the expansion on the higher time frame, but they get a cell signal, and
Yeah.
it's technically against the basic strategy. Do you want to speak to that at all?
Yep. In fact, that was something I want to talk about because we've been getting a lot of new subscribers, and that the assistant is a good tool if you guys know how to trade this manually already. The worst thing, I'm almost kick myself that I put that tool out. I almost wish I time locked it. When you guys sign up, you can't even touch it for 3 months, because it's the first thing people do, regardless of them going through the training. We say you need to spend time learning ATS. You need to spend time learning like what we're talking about right now, the framework. You guys load that assistant up, not all you guys, but some of you, and just start rapid firing the signals and wondering why it's not working out. And it's because it's just a tool designed to show you potentially a sweet spot to enter, but you still need to understand the analysis. All the signals are not good, to work out and just turn into huge trends. It doesn't work that way. It's just showing you counter trend liquidity. That's it. So, again, I know people join, there's so much Forex junk out there, especially EAs and stuff, where everyone just wants some plug and play thing, even though, like I said, we don't say that's what it is. But I just know that there's just a strong inclination for sometimes to say, okay, this is going to finally be it. I could just buy and sell and print money. It's just, there's nothing like that. I'm sorry. But what Shane's talking about, let me pull up a 15-minute chart because I know a lot of you guys run it on the 15.
Could we also take a look at a euro dollar? Maybe do this on euro dollar.
Sure. Yeah.
You
Switch it over. Yeah. So we'll do 15 of the 4 hour. So regardless of the signals that you guys get from the assistant, they should hold little weight to the analysis that you do on your higher and lower time frames. If the market conditions don't look great on the higher time frame, as if you didn't have the assistant, then you leave the signal alone. It's just supposed to, it's a basic thing. Now I am working on getting it a lot more advanced, to obviously we want to get it dialed in. The better, we can get it to pinpoint good opportunities, we want to, for sure, obviously. But the tool is just something to show, okay, we have a color change on a candle and we're getting a counter trend pullback timed with the expansion phase. That's it. Super, super, super basic. And that's all it's supposed to be. That way, if you're trading, let's say you're trading the 15 into the 4 hour, like right now, actually you'd probably get a signal. If you're using the 4 hour as your supporting time frame, you're using the 15-minute as your entry time frame. The minute you broke short out of this box, you probably, in this case, this is probably a grade A signal, right? However, you look how whippy this 4 hour is. This is not a great market to trade in. Now, this may actually whip across a box. It very well may, but understand what you're dealing with. If you're going to trade this, trade this long, just look at the 4 hour, and also the 4 hour has started to hold under expansion. That's a clue against that trade. So if you're getting the grade A signal right here, you very well may range across this box and get up into this neighborhood, which could be a decent trade, 30, 40 pip trade coming back to the high. However, would you go in there and throw 200 to 1 leverage, and max yourself out and say it's a grade A position, it's got to win? No. All it's doing is looking for specific conditions. We have a color on that higher time frame and we're getting a counter trend pullback. Like I said, it's super, super, super basic. It's just supposed to be a helper, so that if you're walking around, let's say you're trading the 15 to 4 hour, maybe you're making breakfast or you're doing something, you get that signal. This is something we're definitely interested in, but you may not be interested in this situation where we're against the average price line over here on your higher time frame. It's not something that we may want to deal with. And you look at it and say, okay, Is it a good opportunity? Nah, it doesn't look that good. Forget about it. But again, that's what the tool is supposed to be used for. It's not supposed to be some plug and play, just follow the buy and sell signals. It's going to get better and better over time, but there's no substitute, regardless for what you guys are doing. There's no substitute for screen time and understanding the analysis and being able to weight those signals. So um, anyway, like I said, you want to apply, there's no shortcut around understanding the knowledge and understanding the global view of the master pattern like we talk about, and having mostly it just comes down to screen time. So you look at this right here, just again, looking at that global view. I knew we are going to use that as a theme. If you guys look back here, where's the sensitive boxes? This whole thing is full of sensitive points, but look at the swing high, swing lows. Swing high, swing low. Showed that box. That's when you first had this drop coming out of this 4 hour right here, right? So you have the 4 hour rotate. This is probably your grade A signal. I wasn't watching Eurodollar when this happened, but grade A signal, boom. Okay, this one worked out good. You were under average price. You know, that was a grade A signal you probably would have wanted to take a chance on, right? That paid you. Now here comes a grade B signal that also puts you into the money, but now you're whipping back up. But what's going on here? Swing high, swing low, swing high, swing low, swing high. How many is that? 1, 2, 3, 4. We're on the 5th swing high, swing low coming from this point of origin, right? So if you're going to rip this long on that new grade A opportunity, looking at the overall framework, all the boxes working together, you know, where's that sensitive price level? Probably the most sensitive is right in here, but you can see we have a cluster. All these are getting swing high, swing low, swing high, swing high, swing low. You got a lot of crazy activity happening in here. So, you know, this whole area becomes that sensitive price. So but again, this could come all the way back down and come down to here if you're looking at the global overview. We may get another leg all the way down. That's a potential, and you got to be prepared for that. So again, hopefully that, you know, going back and you guys looking at that and trying to look at the more global view as well as the immediate view. You know, you don't want to discount the immediate box and expansion you're looking at, but you may be able to get some more insight by looking at all the boxes, how they're all working together, and where you are in the master cycle. You know, and if it's you know, if you're at this point right here, let's say this hasn't happened, go back and find the last big cycle. Where was it? Let's say if you're down here, right? Well, I'm just generally, just like I said, ease your gaze off the screen. You had one right here, expand high, and then we expanded low, kind of making this box more of a more significant point right here. But let's go back even further. Look at this one. We had the spike high, spike low. So this, again, here's another one right here. Here's one right here. Swing high, swing low, swing high, swing low. A lot of sensitive points coming through this area right here. So you can see that. Where are you in that overall framework? Where was the last swing high? Where was the last swing low? And how is that all playing out? I know this is deep, and I don't mean to confuse you guys. If you stick to the basic strategy, you know, there's enough, you know, as long as you're trading the rotations and trend, you guys should be well off. But increasing your knowledge about looking at this from a global perspective, you know, if you don't overwhelm yourself with it, should give you extra insight when it comes to timing your entries and forming a better overall expectation. But like I said, if this is too complicated, just stick to the basic strategy. Right here, it was simple. You're 4 hours below expansion. Right here, above expansion, you get in, rip it short, take it short, boom. There you go. Cover once you get through the expansion, it held below, goes into a run. This is still that basic trending strategy is still going to fall into, you know, it's still going to take all this framework into consideration for you. And that's the benefit of someone that's never done this, is following that basic strategy, you know, that's new to this methodology, is going to still keep you on the right side of the trend and still keep you in strong winning positions. But the more knowledge you build around this type of trading, the more you're going to be able to see more of the framework that's going on and be able to weigh out the opportunities possibly a little bit better. So anyway, let me catch up on some questions here. I know we're getting a little long-winded. We'll probably take it for another 10, 15 minutes here. and then we'll probably wrap it up. Shane, if you want to touch on anything in the moment, then or for the moment while I'm catching up, feel free. But give me 1 minute, guys.
There was something, just, we didn't, since we were going through kind of a canned PowerPoint, I just, wanted to touch on the volatility report a little bit. I'm always interested if you guys were able to use any of that info. I know a lot of the pairs that were on it last night all snapped short. A little bit less so with NZD CAD, but some of the other pairs were able to start pushing short. Just wanted to check in and see if anybody was able to, use some of that info and maybe get a little bit of that.
Okay, here's something I want to touch on from Richard. Appreciate the question, Richard. So the question is on the grade A sell alert on USD, the one we're talking about here with the 15 going into the 4 hour. Since the 4 hour is below the expansion, isn't that against the system? It's against the basic strategy. Yes, it is. And that's the point I'm trying to make to everyone. It's a basic signal. You're going to get counter trend signals. If you really want to narrow in on the grade A signals, that's a reason not to take this one, is because you're below expansion. It doesn't, the assistant at the way it stands right now does not take the position of your higher time frame expansion into consideration. And the reason it doesn't, and this was something that on the initial version, because I worked on that for a long time, but I have traders that have been with me a long time that will trade counter trend moves. For instance, they'll trade something like this. The grade A signal on the 4 hour going long, you're technically under expansion, but they'll see that, okay, it's deviated far away from the expansion. They'll feel comfortable taking a rip on this corner going long, but they understand they're ripping against trend. But they have enough experience to know it's overextended. Same thing right here. You can see we're above expansion right here. There was, if you look back, there may have been a really good grade A rip on this turn. So just looking at the candle color can show you a grade A opportunity that may show you the turn of the market, which is really good for people that understand how to weigh out the signals and understand how to manage risk around them, but not so good for people that are just getting started and just, trying to follow the signals without having the full understanding. So it's a two-edged sword. That's where you're going to get more grade A opportunities, but you need to ask yourself, how do I feel about that higher time frame? Because it's literally just looking for the candle color. That's it. Now the next version is going to have more filters on it. It's going to have a multi-time filter on it, and it may possibly have an expansion line filter as well that will fall more in line. If you only want grade A signals in line with the basic strategy, then it'll do that. But like I said, when I put the tool out, it was for with a more advanced person in view. Because up until that point, our program wasn't that widely known. And I didn't have, we didn't really try to market this at all. And the people that I had with me had been looking at this type of stuff for a long time. So it was more conducive to just let it be a little looser, because they still like I said, to get a rip like this on a grade A signal. Let's see if there was anything back there. Okay, yeah. So right here, what is this? This is 415, 245. Okay, 415, 4. Okay, so anything after 8. So what happened after the 8 candle? Right here. Okay, so there's your grade A signal right here. You didn't get anything out of here, but right here is a grade A signal coming back up. Right here, there's a possibility to enter off this architecture right here, and take that short as well. So, you would have got the alert right here, but when you get the alert too, it doesn't mean you just rip the trade. It just means, hey, we're in the counter trend pullback. It's something you may want to look at. It may be ready right then and there, or it may, depending on what's going on, it may take a little while. But either way, it's defining that counter trend pullback. So, there may have been a possibility that you would want to rip that coming back up to this level. You would have got the alert here and, open the trade up in this neighborhood, taking it back to this expansion level. You wouldn't get that if it only looked at the expansion line. And so, like I said, like that's the two-edged sword on it, is that you do get more signals and you get more opportunity, but if you don't know how to weight it, and you don't have that much experience, it can become a problem. Same thing with this one right here. You wouldn't have got the grade A signal on this one, which turned into a good run up right here. Let's take a look at that. So this is 414, 4 o'clock candle right there. So anything after that. Okay. So in here, so your grade A signal possibly would have come right here on the breakout of this box, held the architecture of this last box right here, ripped the rotation, grade A, turned into a great trade. You wouldn't have got that opportunity because that was under this expansion level. So you guys see, that's why I made the call not to put the expansion line in there at first as a filter. Because some people may see, okay, I'm under expansion, but they know, hey, the trend overall in general is going up. There's a good chance I could snap this expansion. You rip the trade right here. If you're looking at the overall framework, you could see, okay, I could rip this rotation, put my stop right here. It's still a grade A opportunity. 50-50, it works out. If it works out, it turns into a big winner. There's some people that may want to take that risk. So
And
again,
real quick, touching on risk, I mean, the whole point of it is that you can, as long as you're managing risk, that, you can test these different opportunities, just because it's a grade A signal that happens to be underneath, or against the expansion line. Like, as long as you have low risk on it, you can, you know, you can experiment a little bit.
yeah, absolutely. Let's talk about managing the risk on this one. This was a grade A opportunity. If you're looking at the 15 of the 4 hour, let's talk about it. You just got the grade A signal. What do we do? Well, what time is it? It's 11:07 a.m. and it's euro dollar, and this is from California. I know you guys are all over the world, but typically 11 a.m. You're looking for a quick swing trade. I'm not saying don't enter it, but there's a chance that the volume may not pull through and you could be swimming sideways all day on this trade. But, it's your choice. But it is a grade A signal. So let's talk about what's the possibility that this 4 hour candle is going to hold red. Because if you're going to get paid on this trade, it's got to come back up to here. There's a possibility. It may be even a 50-50 possibility. So, okay, let's say, if it does go, then you know what? You may come up through this expansion line, which is a piece of architecture. You may blow through that expansion line. Let's even look, let's look more over here. We have an expand high out of this box, and now I see an expand low. Just a global overview, this is starting to become more of a sensitive level, which is probably why we're ripping. Again, just doing kind of that gazing back analysis. So how can I justify getting into a trade on this? Well, if this is a swing low of this expansion, that maybe that adds even more probability to this rotation. Maybe it's something you want to take. Okay, so let's say I talk myself enough into taking this grade A opportunity. Okay, I'm going to take it. You buy right here, right? Where do you manage your risk? So this is a demo account here. I'm just gonna rip the trade. So we just, oops. Oh, I don't know what the deal is with this. Okay. Okay, so we ripped the euro dollar trade, right? So now you're in on the rotation. Okay, where do you put the stop? Well, we're looking at the architecture here. What is up with this? Okay. I don't know what this is. This is our webinar computer here, and I never do this on this. Okay, so you rip the trade. I'd probably stick the stop somewhere down here again through these sensitive price levels, because in order for this to work out, you need to expect that these swing high, swing low, swing high, swing low, swing high. This was a pretty aggressive push. You got to expect that that's hopefully over. So if this is going to work out, it's probably realistically needs to hold above these levels of expansion. So your risk, probably your ultimate risk, is kind of relatively down by this expansion level, which is normally what we go off of in trend, right? We look at the previous level of structure. So if you're going to rip it, understand that this is the framework you're dealing with. And do you want to go, should you go rip, 20 or 30 or 50 lots on this type of opportunity? My opinion, heck no. No way should you do that. But, it's your business. What you guys trade is your business. But that, is it maybe worth, to test the water? Sure. Put in a small position. It's not the greatest opportunity. and expect that it could probably still go against you down to here, but it still may be a good trade. So that's, again, if you don't put in a quarter of your normal position, a quarter, and give yourself, if it goes, great, you make a little bit of money on it. If it goes against you, and let's say it gets a reaction down from these sensitive levels, and you see that you're still getting a reaction, well, layer in, because you're only in a quarter of your normal position. Put in another, average your way in. Now, if it gets down below this, cut it, because it's going to become a bad opportunity, in my opinion. Again, you guys are going to do what you want to do. In my opinion, this becomes a bad opportunity if you get much below here. I personally wouldn't be willing to take that risk. At that point, you're starting to rotate short on the 4-hour, and this starts to fall in trend under that expansion, and that's it. So that's how I would generally manage the risk on a situation like this. And then let's talk about the upside. If it works out, this rotation holds, what needs to happen for this grade A opportunity? Well, we got to get through here, right? That's the first thing of business in this trade. Got to get through here. If we get through there, we got to get up to here. Once we get up to in this neighborhood, we've earned the right. So the progression for your favor: first, get up through here. Once you're up through there, move your stop up to under this expansion level. Just my opinion, not giving signals or advice here. This is a, trade at your own risk, disclaimer. This is all theoretical, for you guys, okay? Just my opinion. You move it up to here, protect the profit, and then at that point you're in, and you see if you get through the 4-hour. The whole point of the grade A opportunity is catching it early at the turn. You're right here. You're at the sensitive point of this turn. So if it goes for your favor, this can turn into a 10 candle runner up through here. At that point, it's a huge success. And then you've already got, if you got a quarter of your position, you may get a grade B opportunity up here. You can finance that trade with this first one and pyramid into a good position. That's good practice. Good traders will tell you it's okay. You can average into a good position. Don't average into a loser. And the definition of a loser is when the trading idea is over. It's not the original idea with the original parameters. So when I talk about adding a trade down here, you may say, well, that would be averaging into a loser. No, it wouldn't be, because it's not a loser until it gets down to here. That's just getting a little bit better price because you have the opportunity to, with less risk to your ultimate out. So you can average in to a temporarily losing position based on a defined range that makes sense. So anyway, just want to clarify that. So your take profit on this, initially, just in case you get a spike in your favor, I'd probably just, throw it up here. So you throw your take profit up at that liquidity line just initially, and let it go, but you still are probably going to move this stuff around. But again, it's a progression of behavior now. Now you've entered the trade. Now you expect, well, what needs to happen on this? And that's how, like I said, just my opinion, how I would treat it. So I know I'm getting long-winded on this. Let me catch up on a few more questions here.
I wanted to throw something out there as well. So kind of speaking to that progression that Wade was talking about, right before we had this pullback on the 15-minute on the right-hand side, we see that we had that spike up to the long side. So the progression, if you look at it, we went through one expansion line off to the left, and then we ended up where it stopped pushing up long and we started rotating short. That's kind of the progression that we're referring to. Once you see these different levels that it's going to run into, and you're either going to breathe or rotate. And if you're in a long trade, ideally you want to see it go long, but as soon as you see it start reacting to a price that would be an entry for a trade in the opposite direction, then that's when you want to start looking at maybe closing the trade out and just covering your profit. So when we spiked up and then we started rotating off of those past expansion lines on the 15-minute up near the high of that little spike to the long side, that would be an indication to that you're either going to have to ride through a breath or it might be a reversal. So just something to keep in mind. Every new expansion line or liquidity line, you want to be around to see when that gets taken out and just kind of what the behavior is, so you can, hopefully take as much as you can out of the market and not
Yeah.
ride it through a breath, namely.
Yeah, absolutely. One thing, here's a good question here. Uh, it says, what if there's a bunch of open space between expansions? I know we like to have the close architecture to work with. And like, for instance, we're looking at this, master cycle that's happening with this as the origination point right here. So we kind of have that sensitive point to work within as kind of a defined risk level, or reaction point level. Notice I put the stop loss below that because you want to give it some room for a reaction. If it gets down there, it may swim around in there a little bit. Uh, so what if there's a ton of space? Like, what if you just have a massive push and now it's like, the last piece of architecture to work is like 50, 60 pips away or 100 pips away, depending on the time frame you're working at. What do you do then? Well, it is what it is. So if you get a grade B signal, let me see if I could find an example. Okay, for instance, like this right here. Same thing right here. You had this push short and you guys maybe get, I think this was actually grade A right here. Now you're far away from this, right? Well, you need to understand you're far away from that, and we can't do anything about what the architecture gives us. If it's good, it's great. If it's not that great, guess what? Just don't do anything. Same thing with this rotation right here. As it's working down, you're above expansion right here. You may this, if you rip this turn or get in right here, you still possibly can come back up into this level before you get more information. So in those situations, if you're going to rip the trade, just wait for the rotation, and you're going to have to manage it in that turn because nobody wants to wait till you go back to here. So you don't want to, no one wants to rip the trade and learn that they're wrong over here. So in that situation, if you're going to rip the trade, understand that the wisest thing to do is to manage the trade around the rotation point. And also too, if it's pushed really, really, really far, also like this right here, would you want to just rip the trade right out of this? Look how far this is pushed, from that up here. That was a big rip. It's going to have some sort of correction, right? So again, these are just common sense things here. That just because you get that grade A signal, you can say, you get it on your phone. Say, I got a grade A signal, and you just sell it. There's a lot more that goes into it, that you need to take into consideration. Now, if you rip this rotation right here, again, you still know the potential to really know, if the framework's going to be tested could come up to here. So this one, understand, you could either manage it. If you're managing it off the tips of this, then you took a few hits on the way up to it's just the way it is. But at the end of the day, the 4-hour held, and we did make our way all the way back down to this original profit target. So as long as the trend holds, which is that is the benefit of trading in line with your higher time frames expansion, under expansion, then you do have uh, uh, that in your favor, that there's a very high probability that you're getting back to this level. That's where we talk about the whole 95% win rate. I shouldn't have said 95% win rate when I put that video out. I should have, I don't know why I put that. It's more 95% in the money rate. Win rate is when you actually close the trade. And you guys know from the pain and pleasure video that it's very intuitively, we close trades when they're out of the money because they put us in pain. And so like your hands on a hot stove, you withdraw it immediately. You take immediate decisive action. When the trade's in the money, everyone becomes lackadaisical, or it's not everyone. It's easy to become lackadaisical, and you're like, oh, it's just going to keep running forever. So you have to be much more vigilant and ready to make those calls. But uh, it should be about a 90%, we'll call it 90, 95%. No one knows the exact statistics because there's a lot of different markets, but let's call it 90%. You should be in the money if you're trading in line with the higher time frame trend and coming back to the reference expansion. You should be able to get in the money, but you have to close a trade in the money to hold that. And there's usually a lot more intricacies that go into that. So, you can't expect everyone you're going to do it perfectly. The market gives out different frameworks. that you have to deal with in. So anyway, I don't want to go too much on that tangent, but if you guys see, it is the framework. It is what it is. When you got the signal here, understand that when you're position sizing, you're dealing with the opportunity, there is a long way to get more information if it keeps pulling back. And this one, thankfully, this one pulled back pretty far. Even if you ripped it right here, and you took a hit right here, then give it some more time. That ultimately, if we get much above this and it starts to hold above this, it's probably a full-blown reversal. That's just the box, that's the framework where that the market is laid out, and we can't do anything about that. We just have to try to effectively interact within that framework as best we can, and holding to the trend. So that's what happens. Going back to the question, when you have a lot of space, you have a lot of space. And if it's too much space for you, wait till you get more framework that's closer together that you can manage with a risk that's more comfortable to what you can bear. Um, okay, so let me catch up on a few more here. Okay, question. Thanks, Mary. Mary enjoyed the hypothetical analysis. Did you take the target because it was just below the expansion on the supporting time? Okay, my arbitrary take profit. Yeah, I mean, yeah, I just look generally, it's a force of habit. I just throw it my take profit up around these levels of structure. Most of the trades, especially like we trade longer time frames typically here in California, just because trying to catch swings through London is pretty difficult. We got to be up all hours of the night. So yeah, just arbitrarily setting a management points based on the architecture, but you have to adjust with the framework as it gives you, the more framework as the market goes. So that very well in this trade we may get up to the swing high point on this. So we look at here, we got another swing low, swing high, and we didn't swing low here, which could be a sign that it's holding the trend long. Another reason this may actually be a grade A opportunity here. And that's why, like I said, that's why we want to give. That's why I told them I didn't want to filter out too much, because there's some great counter trend opportunities if you know how to manage them right and if they're setting up decently. Um, but the swing high point is still up here. We may get up to there. This thing may run out of gas, and you're getting that information by that point on this grade A opportunity. You're sitting up, call it 50 pips, and then it just runs out of gas and stops working. I'm not going to just wait because I'm like, that was my take profit. If I get information on the trade up around here that it's like, okay, it's not working out anymore, then I'll probably say, I'll just take the 50 and be done with it. The whole point is getting in early to the turn, is the whole point of the grade A. So it's a signal that's going to tell you, hey, there's possibility. It's the first counter trend opportunity on the first rotating candle on your higher time frame. You should go look at that. When you go look at that, you still need to look at the architecture and figure out, where's my risk management, where's the points, how much probability do I feel is in my favor of the follow through of this, and then you make a decision if you want to trade it or not. If you're trading super heavy, then you may want to stick to only grade A opportunities that are in line with the basic strategy. Like this one right here, grade A, you see that it holds below expansion. Grade A on this rip right here, somewhere in there, rip that, take it below the low, cover. You may only want to take trending grade A opportunities. It's your choice. But if you want to trade the counter trend ones, if they line up and you have a tight risk, position sizing is basically as good as your risk management. If you guys can call the sensitive point of the turn within a few pips accurately, which is what ATS it endeavors to give you sensitive framework so you can potentially do that. Doesn't work perfectly all the time, but it works good enough most of the time. Then your position sizing, if you know that you're 5 or 10 pips away from the danger point where the idea falls apart, then go ahead and rip $1,000 pip if you can handle the risk, because it's like it's either going to go from here or it's not. It's kind of a 50-50 situation. And if it's a great opportunity, well, you could potentially have hundreds of pips upside, depending on your time frame. If it's wrong, you may have a 10 pip downside. That all comes back to risk to reward. If we all knew that it was a sensitive point, if we knew within a 5 pip range that it was going to turn and go 50 pips one way or the other, you could just pick a direction, long or short. If you're at that sweet spot, you're at that tipping point, rip high leverage if you want, but manage it tightly because you're still having a low percentage risk according to whatever account size that you have. If you're running a 100K account, you can trade, a $500 pip because you have it at such a tight risk point, that you're so close to the turn, you could do that. Now, I'm not recommending anyone do that. Again, that's your guys' business. Your guys' money management, what you trade. We have different types of people on here. We don't get into that stuff. That's your guys' business. But understand the closer you are to the tipping point is the better opportunity you buy to lever up on the position. And that's really the idea on the grade A opportunity, is to be able to lever up on the opportunity, and you're close to the danger point. If it's wrong, it falls apart typically right away. If it holds, well, the whole thing, you can rip a high levered position if you want, and you're early to the turn on the higher time frame. There's no better timing than that. You're early to a new trend. And that's the best that we could come up with so far. I know it's still not easy, and we never said it was going to be, but hopefully, you guys are. Hopefully, I'm not confusing the snot out of everybody. So, I think we're gonna. Let me see if I can find one more question. I know this has opened up a big can of worms here. You got a lot of questions. I apologize. I can't get to all of them. We'd probably be sitting here all day long. But if I miss any questions, you guys want to know more about this, go ahead and send the questions to support at Trade ATS. We're always happy to help you guys here over that. So, I'm going to do some quick top-down analysis. I think everyone wants. I saw pound USD, so we're going to look at that. I'm going to leave this trade. You can see we're going. Just talk about this right here. If anyone was running grade A on Euro USD, you're in the money. Again, what needs to happen? Well, we got to get around this point. It's in the money. So at this point, this late in session, I'd probably stick the stop right there and let it be what it's going to be. Once you get up through here, well, guess what? You're in a grade A opportunity, and you've earned the right to see where it goes. And you're probably, once you get above this, you're pretty much guaranteed, as long as you manage a trade right, you're not going to lose money on this opportunity. And you can ride that 4 hour till it dies. That's the whole point of the grade A opportunity. Let me check out gold. So monthly's long. It's that decision point here at that level of architecture. We're getting a reaction on the daily. Where's the master cycle? Swing low, swing high, swing low, swing high. Sensitive point right here. Okay, so on this, if this pullback holds, if you want to rip this long into the monthly, looking at the overall cycle, if you get much below this level, there's a chance you're going back down to here. If you guys look at the master cycle, hopefully you guys learned that from the PowerPoint today. Initially, we're above expansion on this right here. So, but you're short. So momentum wise, let's take a look at the hour into the daily, see where we're at. Okay, so daily's going short. We're against expansion, so that's again counter trend here. If you would have got a grade A opportunity, we'd be pulling short on the daily. Grade A would have triggered probably right here. Yeah, it would have. That's your first expand counter trend expansion. You can trade that, but again, the framework you have to deal with is up here. Let's see if there's any master cycles happening in here. Just glancing over the screen, what's coming to mind? Swing low, swing high, swing low. I'm seeing a sensitive level right here. So You know, again, if you're going to rip this grade A opportunity, go ahead, but manage it around the turn, because the way you're going to figure out any more about this is, you know, until you get up here. So if you're going to rip the trade, you know, adjust your money management and your risk to understand that it could go up here before you get more information realistically. So rip the turn, control the risk above the high here, or, you know, around here. And so far, this grade A has put you into the money. If you rip the grade A, you're in the money, and it's holding below. That's a good clue right here. So you should, you know, you're if you feel like if you're in the grade A opportunity, you want to ride it. There's still a good chance that the opportunity that I'd be looking at, if you're short in a grade A right here, potential upside is to come back to the center of gravity, which is, you know, in this neighborhood, or even right here, looking at the overall expansion, swing low, swing high, swing low, swing high. So right here, in between those, I would look to get down into this neighborhood on that grade A opportunity right here, ripping the rotation, and then see what happens. If you get a big reaction, dump it, take the money, wait for a new one. I'm not going to go any deeper into gold for the sake of time, so we'll leave it at there. Okay, pound USD, hour. Let's take a look at the monthly again. Okay, monthly, I see a master cycle happening. Swing low, swing high, swing low, reaction. Are we going to swing high again? Possibility. But right now we're under expansion. So for momentum purposes, I would stay short for momentum based trades. Let's take a look at the daily. See what kind of opportunity we got on the daily. Oh, there you go. If you're trading the daily into the monthly, there's your grade A signal. Rip the rotation. Why would you manage it around the rotation? Because you're really far away from the last framework. Let's see if we got any master cycles happening in this. I see a couple. Swing low, swing high, swing low, held below, never went to the high again. Boom, broke short, but there was more to that here. We have another one here, swing high, swing low, swing high, didn't break the high, clue there, boom. And then the most recent, swing low, swing high, right there. Notice that they're all moving down. These ones, swing high, swing low, lower expansion level, just little things you could look at. Overall, your monthly short. The minute that candle started to turn red, showed you the momentum, the monthly momentum's headed short. Your first grade A opportunity to leg into a monthly chart. If you're trading swing on a daily, trying to manage a portfolio positions on a monthly time frame, you rip it at the rotation, manage position around this rotation, maybe at the high, see how it plays out. And now you're just about to be home free on that position into the monthly. Once you start holding below, again, you manage your risk off that expansion line. Now you got yourself into a nice portfolio monthly position, bought and paid for. Let it run till your heart's content. If it's going to run, you know, obviously you'd be looking to get to this low if the monthly continues, and then beyond. But again, the grade A opportunity, whole point of that is to be early, is to have just the opportunity to be early. Okay, let me just go quickly to the daily to the hour here. Man, I'm getting jacked up on these grade A opportunities again. I love talking about this stuff. If you guys haven't noticed. Okay, so daily, let's go even shorter. If you're looking at the daily, you have a grade A on the daily into the monthly. Now let's see if we got a grade A onto the daily. Let's stack the grade A's. Okay, we went red on 4/16. 4/16. Let's see, where is it? Okay, you don't get a grade A here because you broke short. That could have potentially went. Where's the grade A? This liquidity line should have fired. As long as the candle held red. Sometimes if it's tight, it'll flash green. If it flashes green, it won't trigger, unfortunately, but it's just the way it goes. But it should have triggered within there. Now you got a grade A that's in line with the daily and the monthly color. So again, if you guys want to weigh out trying to figure out the probability on those grade A's, maybe you want to reinforce it with another time frame. Only trade grade A's when if you're trading the hour into the daily. See if the monthly's on your side. See where the monthly is in the overall cycle. Grade A rip right there. Protect your position up above here. This one a little difficult to live through because it puts you significantly in the money, but it never came back through there. Again, you're expecting the grade A opportunities. You're expecting some follow through the active low and some sort of trend. The grade A opportunities, we really want to see a trend, that forms. That's really the point. We want them to lead to significant trades. So they're typically worth hanging in there on. So that one held right there, and you've legged in. So that grade A, the minute you started holding, see these clues right here too. This is a little difficult, but it's a reality. You have the swing low, put you in the money, swing high, but you're still protecting around that. That's the point of origin for the grade A opportunity. Look at the overall master cycle that's going on here. Let's take a look at that for a second. Okay, a lot going on here. You got one right here, swing high, swing low, swing high. We could use that as a point of reference because it did hold at that middle right here on the swing high. So that's starting to show that it's settling under that, which is in line with the daily candle color. Grade A opportunity right here. So, it's enough to feel like market, there's a good chance it could go short. As it started to go short, when you start getting it, just as when a trend, if you're looking at the basic strategy, when you're not getting through expansion lines in your favor, that's a clue to maybe possibly dump the trade. This one, in this case, is starting to hold expansion lines in your favor, which is all the more reason to stay in. And it's below your entry point. So that's clues in your favor. I know it's all easier said than done. I know hindsight's 2020, but in reality, you guys have this stuff, if you can do out of the 100% that I'm saying that seems obvious, if you can just do 10% of the right things, you guys should be okay. So at the end of the day, it's risk management and finding a strong position into a trend. That's it. Just stick to the rules, stick to good money management, and you guys will be able to not only survive Forex, but potentially be able to thrive if you do enough of the right things and do enough of the things that make sense. Okay. And someone's asking if we could look at WTI crude, which went to zero. This market's insane. My opinion on this market, don't trade it. Just I wouldn't even, the master pattern's still going to play out on all this stuff because again, it's being traded by people. Stay out of this thing. In fact, let's get it off of our screen. Let's go back and look at that euro dollar trade. That was fun. So let's see, just going back, we'll end it with this whole thing of talking about this theoretical trade. So anyway, I'm gonna leave you guys with this. It's still going up. 4 hour looks like it's making progress. I'd say it looks like there's a decent chance, believe it or not, even though we're getting out of session, that's something to weigh out, but it looks like good chance you get through this expansion level and get up to this high. So from where I got in, it's, 25, 30 pip opportunity, good possibility, decent risk management again. And that's why those grade A opportunities, I know you guys, especially if you're running them on a ton of different pairs, good word of advice before we wrap it up, run the grade A signal on one pair, focus down on one pair, because there is no way that you guys are going to be able to, you see how much that I'm thinking through this stuff. I'm looking at master cycles. I'm looking at different time frames. I'm trying to find, is there enough in my favor to rip a grade A trade, or do I not feel good about that? What's the risk man? There's a lot of things to weigh out. You guys that are running ATS Assistant on 5 or 10 pairs, unless you have a supercomputer for a brain that can run these equations fast, which I know the human brain is a supercomputer in itself, it's a thing of wonder, but in reality, our conscious processing power isn't that great. we can't consciously process that much all at once, especially on smaller time frames. Run the grade A assistant on one pair that you are going to decide that this is my pair. I'm going, maybe it's Aussie dollar, maybe it's Euro dollar, maybe it's gold, maybe it's dollar CAD. I don't care what pair it is, because they all will go through their cycles. Right now, Euro dollar is probably not a bad. Someone's asking what pairs to focus on. Euro dollar is actually not a bad pair because it falls in line with all this economic stuff going on with the U.S. If you guys are trading CFDs, which uh, you can get access to the S&P, the S&P 500 and the Dow, the US 30. Those markets are really trending. There's a lot of opportunity in the Dow markets right now. So um, focus on one though, because we're not waiting. This is not something like stock trading where we're just waiting for some sort of news catalyst to enter a fundamental position. There's a lot of opportunity in one pair. One pair. So, add to your consistency. Don't be adding more things to think about. It's enough. You see how much goes into the analyzation of this one stupid trade right here. Don't complicate your life. Trade the grade A opportunities, but take all those things into consideration. If the market has ran 100 pips and you get a grade A, don't just rip it. You're 100 pips away from architecture of learning more information about this market. Those, give them time. Do what makes sense, but foremost, learn the architecture of the market. Learn the sensitive price levels that the software is giving you, and if you decide you don't want to use our software, don't forget what you've learned here. If you go back to using raw charts, find those sensitive points. It's so important that you guys get focused on those, because those are going to be those real tipping points to manage your risk from. All right, guys, thank you so much for being on. Really appreciate you guys. I know we got a lot of people on here that have been affected by this whole virus situation, and mostly I don't. The economic fallout of this thing is I think it's gonna make this virus look like Candyland compared to the financial ramifications that are coming. But we'll just have to wait and see. At least at the end of the day, we have access, even though this is probably one of the most difficult things to do on the planet, is currency trading, or trading in general. It's so worth it. It's so worth it if you can calm your mind and you can come and execute on good opportunities that present themselves to you. You don't force them. Then guys, we have, as hard as it is, we have a good opportunity here, especially in this economic climate. There's nothing else that we could do with our time, especially in these uncertain times, than to focus on something that we have complete control over, as far as our behavior in it. We can't control the markets, but we can control the way we interact with them. It's such a powerful thing, and it demands respect. It demands that you respect money management. It demands that you respect good probabilities on your side. It demands that you rise above the fear and the greed and the pain and the pleasure that it causes. It demands that you act responsible. And if you rise above and get those good habits, even if you fall short sometimes, if you rise above and structure your life and your sleep and your eating and your family and your relationships in a way that allows you to be great for those hours that you're on the screen, then you have yourself an opportunity here to be above the economy. There will always be something to trade. And that's why, that's why it's worth it. So again, guys, I thank you so much for being on. Really appreciate the participation. If we didn't get to your questions, please send them to support@trade.ats. Until the next webinar next week, thank you guys so much. Everyone have a great day, afternoon, evening, morning, wherever you're at. Stay safe and keep trading well. All right, guys, we'll talk to you guys later. Thank you.